I was recently reading an article on how to know if you have a resilient portfolio, and the vast majority of this article focused on controlling volatility within the equities portion of the portfolio, primarily focusing on the question of, can my portfolio bounce back? And yes, that is a piece of resilience, but when we talk about a truly resilient portfolio, one that you might live on, that framing misses a larger question. The real question is this: will your portfolio still work when life and markets get messy at the same time? Because yes, portfolios do fail. And failure generally means the portfolio ran out of money or that it's no longer able to support the lifestyle you want. But generally, these failures don't come because returns are slightly lower than what was expected. They generally fail because of a combination of bad timing, forced decisions, or stress you didn't plan for. So a resilient portfolio isn't just one that can bounce back after the downturn. It's one that can survive the worst realistic scenarios without forcing you into bad decisions that you can't undo. As Michael Kitces has said many times in different ways, retirement failure almost always comes from sequencing, not averages. Hey guys, what's up? I'm Erin and welcome back to the channel. So today I wanted to talk about what portfolio resilience actually means and what the research says it takes to build and test whether your portfolio can survive the worst realistic retirement. A resilient portfolio is one that still works when things don't go according to plan. So really, this is a portfolio that keeps paying you even when the markets are ugly. It doesn't force you into bad decisions, and it survives bad timing. And importantly, it still holds up if inflation, taxes, or healthcare costs come in higher than expected. This is really the gold standard portfolio. And when you look across retirement research from Morningstar, David Blanchett, and Wade Pfau, the same four structural pillars show up again and again. So let's break down those four pillars one by one and talk about what makes a resilient portfolio in the real world. Number one, income that doesn't care about the markets. This one is absolutely non-negotiable. Real resilience comes from having income floors in place. That includes things like Social Security, pensions, annuities, rental income, or really any cash flow that keeps coming in even when stocks are down, say 30%. Research consistently shows that having income floors in place dramatically reduce the likelihood that somebody will sell during a market downturn. It really reduces the emotional cost of volatility. It has a way of turning portfolio draws into a sort of top-up rather than a lifeline. David Blanchett has shown that households with higher guaranteed income can safely spend more even with smaller portfolios because the portfolio isn't doing all of the work. And honestly, this just makes a lot of sense. If you know you have income sources that are going to come in month after month, regardless of what the market is doing or the economy, you're going to feel much safer in retirement. And there's a lot of ways you can work towards building your income floors. You can work on this during your working years to try and maximize your earnings to make your Social Security payout more robust. Then thoughtfully timing when you claim, coordinating claiming strategies with a spouse if you're married. And regardless of income level, whether you're a lower income earner, middle income earner, or a high income earner, it can be important to go into retirement with as few debt obligations as expected, because that makes it so your guaranteed income streams go much further. And I know I've said this before, but I truly believe it. I think the most ideal retirement scenario is to go into retirement having income floors that cover the vast majority, if not all, of your expenses. And that way your portfolio just serves to cover your discretionary expenses. And this really serves to take the stress off yourself and your portfolio in retirement. That is a truly resilient retirement. When your portfolio only has to cover your wants, you can easily adjust this up or down however you wish. Time segmentation beats one big pot of money. Most retirees are unknowingly exposed to timing risk. When all of your money is treated as one big portfolio, you're implicitly saying that every single dollar has the exact same job. But in retirement, that's not true. Resilient portfolios recognize that money you'll need in the next 1 to 5 years should not behave like money you won't touch until year 25. Early retirement dollars carry far more risk weight than later ones because losses early on can do permanent damage. This is why time-segmented approaches show up again and again in the research and in planning. And this might look like bucket approaches. It might look like bond ladders. It might look like cash reserves. This is how we protect against risk timing. Wade Pfau's research consistently shows that separating short-term spending risk from long-term growth risk improves portfolio survival, even if headline returns are slightly lower. And the trade-off can be worth it because in retirement, survival often matters much more than optimization. Protecting your downside can be more important than capturing a little bit more upside when you're using your portfolio to pay for your life. A portfolio that grows slightly less but prevents you from doing forced selling or helps you sleep at night is far more resilient than one that is perfectly optimal on paper. Flexibility is more powerful than precision. This is one of the strongest and most consistent findings in retirement research. You need to give yourself permission to adapt. Resilient portfolios assume a few things up front. Spending will fluctuate, inflation will not be smooth, and some years will require restraint, whether you like it or not. That is why flexible strategies outperform the rigid ones in the real world. And this shows up in approaches like Geitenklinger guardrails, skip inflation rules, or assumed real spending declines over time. These approaches consistently show higher starting withdrawal rates and higher survival rates than sticking to one specific inflation-adjusted withdrawal. And the reason they survive is pretty simple. People stick to them. In fact, research summarized by Morningstar has shown that even small, temporary spending adjustments during market downturns to the order of, say, 5 or 10% can meaningfully reduce the risk of long-term portfolio failure. And keep in mind what a 10% reduction on your portfolio draw actually means, because this is not a 10% reduction in spending. Let's put some numbers to this. If you and your spouse are bringing in $4,000 a month from Social Security and you're drawing $2,000 a month from your portfolio, your total monthly spending is $6,000. Now, if you temporarily reduce your portfolio withdrawal by 10%, so instead of drawing $2,000, you draw $1,600, that brings your total monthly spending from $6,000 down to $5,600. That's a $400 reduction, which is about a 6.7% reduction in total spending, not 10%. When guaranteed income streams are doing even part of the work, even a meaningful adjustment to your portfolio draw results in a much lesser lifestyle adjustment than what people might expect. And flexibility really does two things. First, it often gives you permission to start with a slightly higher withdrawal rate because you're not locking yourself into an unsustainable promise. And second, it allows you to better use the portfolio you've worked so hard to build, instead of underspending out of fear just to protect a rigid rule. It really comes down to the fact that the best approach is the one you don't abandon. It's the one you can stick to, and having flexibility is what makes this possible. And finally, tax resilience matters as much as market resilience. This is really one of the biggest blind spots in most retirement plans. Most of us follow a very simple pattern during our wealth accumulation years. It's put your head down, save, invest, accumulate. And that works until you get to retirement and realize there may be tax consequences you never planned for. A portfolio isn't truly resilient if RMDs push you into higher tax brackets later. IRMAA surcharges spike your healthcare costs, Roth conversions backfire, and capital gains stack poorly with Social Security. So let's put some real numbers to this and talk about why taxes can undermine an otherwise solid plan. Once you get to RMD or required minimum distribution age, withdrawals are mandatory. They're no longer optional. And if you have large account balances, these can grow fast. After all, that's the magic of compounding, right? Consider that a $1.4 million traditional IRA at age 73 produces a first-year RMD of roughly $53,000. And that required withdrawal generally rises over time, even if markets are just average. And that income, which is treated as ordinary income, stacks on top of everything else, whether that's Social Security, a pension, annuity, capital gains distributions, and this is whether you need this money or not. And suddenly, retirees who thought they were in their low tax phase of life find themselves pushed into higher tax brackets than they ever expected. And then there's Medicare. Crossing an IRMAA threshold can raise Medicare Part B and D premiums by thousands of dollars per year per person. And those surcharges are based on just $1 of extra income over the line. And for married couples, there's an additional consideration. When one spouse dies, the survivor moves from married filing jointly to single, cutting tax brackets nearly in half, while income often stays largely the same. That alone can cause a permanent jump in lifetime taxes if not planned for. And this is why tax resilience is so important. True resilience means multiple tax buckets, not all tax deferred. Thoughtful withdrawal order planning, not we'll figure this out later, and awareness of future tax cliffs, not just today's marginal rate. Because ignoring taxes doesn't make a plan simpler, it just has a way of delaying the problem and often making the problem bigger down the road when the consequences are harder to undo. Of course, we have stress tests, and Monte Carlo tests can absolutely be helpful, but they alone are not sufficient. They only rely on a limited number of inputs. They tend to assume average market returns, they tend to assume constant spending, and they don't assume shocks from taxes or healthcare. These tests are really good at measuring math, but they don't have a way of measuring behavior under stress, and that can be a problem. Think of these stress tests as answering one core question. What breaks my plan? Bad timing first. This is where you want to start. Ask yourself, what happens if my first 5 years of retirement look like 2000 to 2002 or 1973 to 1974? How long can I avoid selling stocks? If your answer is not that long, your resilience might be rather weak regardless of what the long-term average says. Then look at the income-only survival test. Strip away the portfolio. Ask yourself, how much of my essential spending is covered without touching my investments? Could I survive 5 to 10 bad years? This test alone fundamentally tends to change how many people view retirement risk because it changes the role of the portfolio. It puts it in a more supporting role rather than being the sole support. Then we have the flexibility drill. This is a harder question. What if the market falls 20 to 30%? What exactly do I cut? Now, is this cut realistic or is it just good in theory? If you truly can't name anything that you can cut, you might not have much flexibility. And finally, tax shock scenarios. This is where we test those silent risks. What happens if you cross an IRMAA threshold? What happens if you have a widow or a widower situation? What happens to your tax brackets? What happens if your RMDs accelerate? What happens if you lose deductions you assumed would always be there? A lot of plans that look successful on paper might break in these scenarios. These often not tested for scenarios. So if you're building a truly resilient portfolio, you also want to test for these silent threats. When you strip away the noise, the expert consensus is actually very clear. A resilient portfolio isn't about chasing the highest returns or optimizing to the decimal. Rather, it comes down to core fundamentals: guaranteed income floors, time-aware assets, rules-based flexibility, tax foresight, and behavioral realism. Or said more simply, a realistic portfolio asks, will I still be okay on the worst realistic day of my retirement? That's the difference between having a plan that looks good on paper and one that you can truly live with year after year. And before you go, I want to leave you with something practical. This isn't about running projections or software. This is a way to self-assess your real resilience. Score yourself yes, somewhat, or no on each of these. As you go through this, keep this framework in mind because this checklist will help you answer, do I have structural defenses in place? In the income category, do guaranteed sources cover most of my essential spending? Could I go years without selling stocks if markets were down? In the time category, is near-term spending protected from market volatility? Do my long-term assets truly have time to recover? Then we have the flexibility category. Do I know exactly where I'd cut in a downturn? And am I emotionally prepared to actually do it? And then finally, the taxes category. Have I stress tested RMDs, IRMAA, and the widow or widower brackets? Do I have multiple tax buckets to draw from? This checklist is designed to do a couple things. To make the abstract concrete, to make a complex situation something where you can bring it to self-awareness, and really prepare you to interpret future stress tests correctly instead of being surprised by them. And if you can't confidently answer yes to all of these, it just might mean you have some work to do to make your portfolio more resilient. Resilience is preparing for uncertainty. As always, the goal is not to retire with the most money possible, but rather to build a plan that can support your lifestyle no matter what the circumstances. That is true security. So what are your thoughts on a resilient portfolio? Have you stress tested yours? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Where you have your guaranteed income streams covering most. Oh, did you see that my face froze? So a resilient portfolio isn't one that just rebounds after the downturn. It's one that I think I might have said consequence instead of consequences. So I'm just going to reshoot that last one. And that works until you get to retirement and realize there may be tax consequences of everything else. Social Security, a pension. Please consider sharing. I'll see you soon. Bye.